Hello, I'm Greg Bunnell. Welcome to Market Call. Jaime Carrasco's on the show today. He's a portfolio manager at Canaccord Genuity. He wants to take your calls, emails, and tweets on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. So give us a call, toll-free, 1-855-326-6266. You can also send an email to marketcall@bnnbloomberg.ca. Good to see you again, Jaime. Always a pleasure to have you here.
Thank you for having me back. Always good to be on.
I know you're a man who always keeps a sharp eye on the things that concern us in the global economy and domestically. And for a while now, you've been saying you're not happy with what you're seeing. And I assume from some of the different messages we're getting now on the Fed and the Bank of Canada and from economists, your suspicions are only getting confirmed.
Well, I've taken a contrarian approach for quite a while because I come from the bond side. I think debt is debt is debt. You can't solve a debt problem with more debt. I'm happy to say, though, that the strategy we've been following is starting to yield some nice returns, and I think that's just beginning within the special opportunities portfolio and a lot of the portfolios that my clients are holding. Things like Kirkland Lake, North American Palladium, Largo. A lot of these companies have sprouted beautifully, and it's a clear indication of what's to come with the rest of the portfolio. The stock picking is working. That doesn't change the fact, though, that the central banks are stuck between a rock and a hard place. We've gone from about $100 trillion in 2008 to $250 trillion in debt now. The next recession's coming. What do we do now? Are we going to go to $700 trillion? Because if you look at the expansion, it's got to be exponentially higher. Well, something's got to give, and I think history has taught us that every time we've gone into a situation where we've solved debt with more debt, really the only way forward is for some kind of a monetary or debt reset. And always, that has been done through gold. For 4,000 years, gold has been money because it's the only constant thing that we can all trust to revalue things to. And that historical constant of that barbarous relic, as they call it, as they love to call it, I think it's important. Central banks are signaling that. What it was reported about a month ago, that last year they bought more gold since 1975 when Nixon and pegs. To me, that's a clear indication that I'm on the right track, even though the way that the message is being managed, those that understand are buying physical, are taking the physical away. And I think the producers is the place to be for the average investor, especially Canada. We're 80%, we just finished PDAC, 80% of mining comes out of here, and there's a lot of good companies to be had.
I was going to ask about the retail investor. So obviously it's not, say a regular guy like me, I'm not going to have a bunch of bricks of gold in my house, but you think put the money into the miners.
You know what, it's funny, I've always said don't put all in, but have at least, I started about 5 years ago with a 10% allocation. Now I'm sitting at least a 20% allocation with everybody, been increasing the allocation. It's about portfolio management. It's about having that hedge. Right now, if you look at the concentration at the asset allocation within the precious metals of North American investors, it's zero. Within pension funds, zero, nothing, right? But what do you have? You have guys like Gunlash, Ray Dalio, all the debt guys, the guys that come from the debt side, warning about the consequences of debt and how we're reaching some points of no return. I think we've already reached it long ago. To me, it's a massive opportunity. If history replays, there's a lot of wealth to be transferred over to these assets, and it's going to be a beautiful transition, and we're really showing it. And I think through the show we're going to talk about some of the top picks that are still there, and some of them have been doing extremely well.
How do you feel about what often gets referred to as paper gold? You buy an ETF representing gold, but you don't actually own gold, you own a piece of paper.
I've always said that the problem is that's why I like the producers. Reserves on the ground are on the ground, it's not paper. My analogy has always been a game of musical chairs where the Chinese are pulling out the chairs, but the paper gold, the physical contract. Last month, the Bank of International Settlements did 54 tons of swaps. That's how they're suppressing the price. That's the paper game. So the way to see it, it's a game of musical chairs where you're coming into the game. More guys are coming in with a piece of paper. The chairs are being pulled away. What happens when the music stops? Palladium signaling what happens. Palladium is up almost 100% since last August, I believe it is, because the physical market is overwhelming the paper market. And I think that's going to be the case for a lot of things. We can't manipulate markets without consequences. I've been positioning clients to benefit from those consequences. And shortages will be there. You know, the Chinese have been taking away tons. The Russians, the Indians, Asia, and central banks now. So that will have inflationary consequences.
Interesting times indeed, and just a warning today from the senior deputy of the Bank of Canada that all of this debt that we've incurred at home and abroad is holding back economic expansion. So that's the tough place you're talking about.
Well,
you throw more debt on it. That's been the solution before. Let's give people cheap money. The economy grows. Well, now we're in a
right, and that's the problem with the the marginal utility of debt. 10 years ago, maybe 20 years ago, for every dollar issued you were generating $6 of GDP. Now it's what, 10 cents? It's not working. It can't continue to work, right? And because of that, I think people should start thinking for themselves on how you position yourself and use history as a guide. I think there's a lot of money to be made because of it.
A lot of interesting discussions to be had in the next hour. We'll be back with Jaime Carrasco. He's a portfolio manager at Canaccord Genuity. Wants to answer your questions on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. So give us a call, toll free, 1-855-326-6266. Time for Past Picks. We go back to June 22nd of 2018. You liked Hive blockchain back then. What is going on with Hive?
I still like Hive, actually. The way that I see the blockchain is, remember the .com back in 2000? Well, out of that, we ended up with Facebook, Twitter, eBay, all of these companies come out of there. I think it's the same thing. The technology is beautiful technology, is a ledger, an electronic ledger. A lot of firms, Fidelity, are continuing. A lot of financial firms are introducing blockchain-backed Ethereum platforms to track all of that paperwork that needs to be tracked. And I think Hive is one of the ones that will benefit out of that.
So Hive is the quality name there. I'm thinking there's other names like Long Island Iced Tea became a blockchain company.
Right.
That was that frenzy for a while. Right?
Hive is actually a miner. Yeah. Similar as Agnico. What they're mining is Ethereum and a Bitcoin now and Zcash, which are actual coins that are being implemented by the industry. They've been mining, they're the biggest public miner in the world. So I think that throughout this period, they've been continually mining more and more coins that are going to be needed. Because of that, again, the strategy has been to be about a 2.5% of the portfolio, and I've continually added as it came down. We just added again in January. We reorganized the portfolio. Once again, took profits from some of the names that were up quite a bit, and this is one that we bought. So I haven't lost faith in it. I just think it's early, but I would have loved to have bought Google back in 2000. Look at what's happened now. Everybody wants to chase it now. Well, I'd rather be buying them when they're in the dirt and nobody likes them.
Right, from crypto mining to more traditional mining. Agnico Eagle Mines is lying pretty much just flat over the time. Yeah,
this has been one of my constant top picks along the way. Management has performed in an unbelievable way. This company will be completely self-sufficient by the year 2022, I believe it was. At that point, they will never need any more money, and a lot of that money will get switched over to the dividend. Now, the dividend payment actually has been increasing with them. Their cost of production is down to about $650 Canadian. And by the way, gold in Canadian dollars is almost back where it was at 2011, almost at 1800. People haven't noticed what's happened to the Canadian dollar. If you bring up the chart back to 2015, which is the real key to Agnico, it was down at 22 bucks and we're sitting at 58. So it's one of those that has sprouted nicely, and I think it will continue to deliver. One of the issues with Agnico, though, is that it's followed by a lot of institutions. So a lot of funds got rid of their precious metals position and they sold them. But to me, it's one that I continue to hold within the portfolio, and it should deliver well. One of the things that I think we're going to get out of these companies going forward is increase in dividends. We're starting to see it. Kirkland Lake has started a dividend. Agnico has increased its dividend. Franco-Nevada has increased its dividend. So that's starting to happen. So the strategy is playing out, but patience.
Patience. All right. North American Palladium was the third pick, and this is the big winner. Total return of 57% since June of last year.
Again, North American Palladium is one of those companies where we're starting to see that disconnect between those paper contracts, the musical chairs, and the chairs not being there. That's the problem. The Chinese and the Russians have stopped selling us palladium, so all of a sudden we have a massive problem. Oh, we don't have it. But yet we have all of these paper contracts sitting around. So if you do a chart of palladium prices is really the important thing, because they were trading at about $800 last August and we're sitting at $1,500, right? And palladium storage, it was in massive backwardation for the longest time, and now that it's showing in the price, I think that will also start to happen to silver, gold, as the paper shenanigans stop to. Manipulations never work forever, and people better understand that. The closing of the London gold pool back in the early 70s, which forces Nixon to unpeg, is a clear indication of that. There's palladium spot, and it doesn't seem to be wanting to come down anytime soon, and it's creating a massive problem.
Interesting plays. We're going to be back with Jaime Carrasco. He's a you got
one last thing. With palladium was one of those that when we cleaned up the portfolio in January, we took profits out, right? So again, we're selling into the ones that are making and re-rolling them, buying the ones that are down right now. And the portfolio, I love every company that's sitting in there.
All right, man who loves his own portfolio. We'll be back with Jaime Carrasco, portfolio manager at Canaccord Genuity. Let's answer your questions on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. So give us a call. It's toll-free, 1-855-326-6266. Got a minute and 50 seconds and 3 top picks. Whoa, North American Palladium, let's start there. You still like it?
I still like it. It's one that I've actually taken a bit of profits, but I think it has upside. I bought it because it's the only palladium producer, main palladium producer, and look at what's happening with palladium prices, so it should continue.
Kirkland Lake Gold is next on the list.
Kirkland Lake Gold has been the best performer in the portfolio. It's one that I've taken some money off, but it'll continue moving. What I like about it is really showing us what's going to happen to all of these companies once they start moving. Reserves on the ground, good production, solid.
We went through the first two very quickly because I know you want to spend a little bit of time, and we don't have much on Valens Growworks.
Right. This was my first entry into the wheat sector, and what I looked at was the fact that these guys are extracting the chemicals. The different industries need the extraction. It's being done through oils. These guys are extractors, and because of that, the margins are higher. They're just getting going in revenue. I think this company will eventually get taken out. They have all the licenses. It's important. I have to warn, though, that I will be taking a bit of profit off this because there's a convertible bond coming out of another extractor. So I'm going to diversify into another one with an 8% yield plus conversion and a half warrant. So it makes a lot of sense. I want to own both. But this was my first entry into what I think it's, alcohol after deregulation in the 30s. Again, the 30s are repeating as well with weed, and this one's it.
All right. Always fascinating to have you here, Jaime. And if we want to look through those topics a little too fast for you, you can always head over to the website, bnnbloomberg.ca. Look forward to the next time.
Always a pleasure being here. Thanks for inviting me back.
That's it for this edition of Market Call. Stay tuned. Don't turn off the TV. Lots more great stuff coming up on BNN Bloomberg.
And thank you to everybody.